Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi, my name is Ravi. Welcome to a special podcast on a series on India Market Outlook 2023. Today, I'm joined by my colleague, Mr. Manpreet Gill, CIO for the Middle East, Africa and European region for Standard Chartered Bank. Welcome to the podcast, Manpreet.
Thanks, Ravi, for having me.
So let's get to the first question straight away. 2022 has been a challenging year for investors, with volatility escalated across asset classes. The outlook for 2023 also remains challenging. So how do you see the growth and inflation dynamics panning out in 2023?
Well, hi, Ravi. I think you hit the nail on the head. I think 2022 was indeed a challenging environment. But I think when we look ahead at 2023, it depends where you look. Now, if we start with the US, we do expect, the economic growth environment to slow. The Fed's been raising interest rates for some time, and we think it'll have some success as a result in helping sort of bring inflation, move at least in the right direction. But what that does mean is that growth is likely to slow as a result, all the way we think into an economic recession. So that's sort of one sort of cornerstone macro view that we're sort of, taking going into 23 and perhaps even a little bit beyond that. Now, that's of course the view for US, and we think even, a lot of that will carry over to Europe. Over in Asia, it's a little bit different. So here in India, of course, the domestic growth outlook is arguably a lot stronger. So while, slowing growth in the US may provide a bit of a headwind, we do believe that, the domestic growth, drivers are likely to more than offset that. So, economic growth should hold up a little bit better, particularly with inflation not having been quite as much of a challenge. China is the other piece, of course, from a macro perspective, which we think looks interesting. Obviously, China's been at a very different point in the cycle, with growth already having slowed last year, but policies actually, if anything, been turning more supportive, with rate cuts already having kicked off in late 2022. So that, together with the mobility restrictions, means we think China may end up actually witness accelerating economic growth, and of course, inflation not really being a challenge there. So a little bit different depending on where you are, but we do think slowing growth in the US, but potentially holding up much better in Asia.
So what does it mean for USD and crude oil, two variables that were very widely discussed in 2022?
So I think first for the US dollar, I think that's actually the most interesting one, because over the past 2 years, the dollar has strengthened quite a bit, and it was supported almost entirely by rising interest rates in the US, with the Fed really leading the charge on that front. But we actually think 2023 is going to be a year where the dollar continues to move lower. Now, we've seen some weakness already, and perhaps, that's due a bit of a short-term consolidation. But, from a broader perspective, as the Fed sort of approaches the peak of its cycle and the discussion gradually shifts to when the Fed may eventually start to cut amid slowing economic growth, we think that will eventually, lead to a weaker dollar. And that, of course, is quite interesting on several levels, not only for FX markets, but we know a weak dollar tends to be quite a positive tailwind for emerging market assets. Oil, though, perhaps more of a range-bound view. We expect WTI, for example, to stay around $75 per barrel. Normally, when you expect slowing U.S. economic growth all the way to a recession, oil prices tend to fall as U.S. demand sort of starts to slow. But we think this year things are a little bit different. We're obviously going into the year with some of the lowest inventory levels on record. And obviously, supply has been far less responsive than usual to rising prices. And China may very well end up, offsetting the weaker U.S. demand to some degree. So all in all, we think, that pressure may still be to the downside, but perhaps better mitigated than what we're normally used to in U.S. recession.
Well, having said that, what does it actually mean for investors? How does one navigate the near-term uncertainty in 2023?
Well, we think it's about taking advantage of the opportunity this environment presents us, because we do think it'll be quite different from 2022 when most asset classes faced headwinds of their own. The first place we'd look is actually in bond markets or income assets more broadly, because one of the results of tightening central banks around the world, both here in India and elsewhere, is that we're able to generate yields or income at levels that we haven't seen in a long period of time. In some global markets, it's actually been the highest yield level we've seen in a decade or longer. So that's the first place we look, and that's why in terms of a big theme for 23, actually securing one yield is one cornerstone. Now, that's obviously one area, but besides that immediate opportunity, we equally think it's important to allocate to long-term value. That's always an important sort of frame of mind to keep in mind for long-term investors. And when we think about global markets, we see that actually in Asian equities, which no surprise as we discussed off the macro outlook. If we expect growth to hold up better in India and China and indeed most of Asia, that should feed through to earnings and valuations, at least for large parts of North Asia, are not expensive. But if we look onshore in India as well, there are obviously we see long-term value in a few specific areas. So financial is one example of that, with financials obviously benefiting from both improving bank balance sheets and credit quality over the last few years, but also, corporate deleveraging. Both of those, of course, setting us up quite nicely, we think, for the sector to start to perform. That's one. The second, of course, again, staying with the theme of, policy priorities is, structural themes like infrastructure. Again, it's an area where we've seen, policy efforts over the last few years. We've seen those continue indeed with the, strong capex plans in this year's budget. But we think all of these are starting to come together to a point where we think it makes sense for investors, to access the value we think is available in these themes.
So that was S&A for the SAFE strategy for 2023. What is F and E?
No, indeed. I think not to miss out F&E. I think so. The first two capture some of our highest convictions, but F&E is about getting the portfolio right as well, right? All the rest of the components of a well-diversified portfolio. So F is really about fortifying against further surprises, in an environment where we expect the Fed to keep tightening until growth slows and US growth to fall into a recession. We know from history that these are the kind of environments where events can, take us by surprise. So to us, good examples of fortifications are perhaps a slightly a slightly larger allocation than usual to cash, given the elevated yields, gives a bit of dry powder to take advantage of opportunities, but also gold. Not only because, falling real bond yields may offer a tailwind, but also gold can be a good hedge against short-term volatility events, if not for the long term. So that's on F. And E, of course, is more about expanding beyond the traditional. I think what's been one of the key learnings from 2022, which is something we knew over the long term, but really sort of, came to real life in 22, was the diversification value offered by alternative strategies. If I look at global markets, for example, while equities and bonds both were down by a lot, many alternative strategy indices actually held up much better. So it's still sort of a neutral view, a core holding view, but I think the broader point is to use that neutral allocation to alternative strategies well.
Well, that does give a brighter picture of things, but we've seen, over the past few years, in 2020, it was the surge of COVID pandemic. In 2021, it was the second wave. And in 2022, it was the inflationary pressures and the Ukraine-Russia conflict. What should an investor prepare for in 2023?
Well, that's an interesting list, right? Every year there's been an awful lot to worry about. So I think, look, there's one set of risks that by their nature cannot be forecast. And I think that comes to the F in SAFE, fortifying ahead of those events. But in terms of sort of the top things we worry about, I think one, of course, is the risk of a policy accident, or in other words, policy over-tightening. We're seeing that debate play out in the US, for example, where, there's debate about whether policy is already restrictive versus what is still very strong US labor market data. And that's a debate that's playing out for almost every major central bank around the world about whether policy levels are appropriately tight or whether they're too tight. And I think that's one risk we'd worry about. The second one, of course, is geopolitical. In 22, we sort of saw that things come to a head with the Ukraine conflict. And of course, energy prices were the channel by which that geopolitical risk translated to financial market risks. Now, again, at least in the short term, for a short period of time, asset classes like gold can offer a hedge against that, though obviously not as much if those kind of risks tend to play out. So with geopolitics, the key is really to figure out whether it's, whether a particular event is a short-term volatility event or something that alters the longer-term, structural direction. But that's something which has to be evaluated case by case. But I think in terms of, what are the broader risks we're following, those are really the two. I think the risk of a policy accident and the risk of a geopolitical accident.
Would there be an off chance that we may see a surge in commodity price shock further in 2023?
Well, not something we're sort of watching as a central sort of risk. We discussed obviously energy prices where our views are a bit more range bound, sort of offsetting the negative side. Gold, of course, more as a hedge against short-term volatility. Let's say in gold, the risks are a little bit to the upside. I suppose one area we haven't discussed is industrial metals, right? And I guess that's where, if we see Chinese growth start to rebound in a bigger way, the obvious question about whether that starts translating into commodity prices from an industrial metal perspective. I think the perspective we take is that at a broad macro level, yes, stronger Chinese demand should be supportive for the industrial metals area. And the macro sort of way to implement that would be through broad commodity exposures. Globally, for example, the Aussie dollar is one potential beneficiary of that and a weaker US dollar. But with industrial metals, often ends up being quite a specific demand supply story. So supply an equally bigger factor. So it's harder to have a broad brush story there. Bottom line is we're not looking for a significant surge outside of the old pocket where supply may be constrained.
Thanks, Manpreet, for the wonderful insight. It was a pleasure having you at a podcast.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.